If you're planning to retire in 2025, you're probably doing everything right. Maxing out your retirement accounts, reviewing your investment allocations, maybe even speaking with a financial advisor. But there's one major risk that most traditional portfolios overlook: overexposure to the public markets. You see, most retirement strategies rely heavily on stocks and bonds, but in today's market of extraordinary inflation, higher interest rates, and global uncertainty, that mix alone may not give you the stability or income you need in retirement. And when the market turns, like we've seen recently, it's retirees who feel it the most. Why? Because you're no longer investing, you're withdrawing. That means volatility, and this is where the trefoil approach comes in. This strategy was developed over 2 decades and thousands of touch points with high net worth investors, financial advisors, accountants, attorneys, and other professionals in the money business. This approach serves as a guide when analyzing portfolios and allows me to determine whether private or alternative investments are the best thing for that particular investor. In this video, I'm going to break down why adding alternatives like private real estate, DSTs, and other non-market correlated assets could help reduce risk, improve income stability, and create a retirement portfolio that's better built for the world we're living in now. If you're planning to retire in the next year or two, this could be one of the most important adjustments you make. Hi, if you're new here, I'm Ron Glasgow, founder of Glasgow Investment Solutions. I spent nearly 10 years as a financial advisor with 2 of the largest investment firms in the country before taking a 13-year detour into private equity. On either side of the desk, there was a consistent demand to help portfolios stabilize income and preserve wealth. Private and alternative investments play a crucial role and give true diversification to the portfolio. At Glasgow Investment Solutions, we specialize in private real estate, 1031 exchanges, Delaware Statutory Trusts, private credit, and other institutional quality alternative investments that go beyond the public markets. Let's talk about why this strategy might matter more than ever for those of you retiring in 2025. For decades, the foundation of most retirement portfolios has been built on what's known as the traditional 60-40 model. That is 60% stocks and 40% bonds. It's been the gold standard for investors seeking a balance between growth and safety, and historically it worked. The ideal is simple. Stocks provide long-term growth, while bonds offer a cushion during market downturn. When the stock market dips, bonds tend to hold their value or even rise, helping to smooth out return. For a long time, this balance served retirees well. But here's the problem. We're not in that environment anymore. There are nearly 40% less public companies than there were 30 years ago. 87% of U.S. companies with revenues over $100 million are private. That leaves near retirees in a difficult position. You spent years building your nest egg, using the rules you were told to work, but now as retirement approaches, the very tools that were meant to preserve your wealth may be putting it at risk. The challenge isn't just about performance, it's about timing. When you're withdrawing from your portfolio to create income, you're more exposed to what's called sequence of returns risk, which means that poor market performance early in retirement can have an outsized negative effect on your long-term financial health. If stocks and bonds both fall at the same time, and you're pulling income from those accounts, it's much harder to recover. That's why so many people are now looking beyond the traditional 60-40 model to diversify more meaningfully and reduce their exposure to market swings. And this is exactly where the trefoil approach comes in. This allows me to address a very real problem in an organized and process-driven manner. When most people think of investing, they typically think of stocks, bonds, mutual funds, and maybe a few ETFs. What happens when those traditional tools no longer give you the protection or diversification you need, especially in today's unpredictable markets? That's where private and alternative investments come in. The major distinction is that private investments require the investor to be accredited. You can read the exact definition on my website, but the basic rule is that you can qualify with multiple years of high earnings by having a net worth of $1 million not counting your personal residence. Similar to the concept with stocks. Most all private investments are alternative investments, but not all alternative investments are private investments. This can be confusing because each typically cover the same investment segment, but always outside of the stock market and the bond framework. They include things like real estate, direct ownership and structured vehicles, private credit, private equity, commodities like gold, oil, and agricultural products, real assets like infrastructure or farming, and one that's growing in popularity among your retirees, Delaware Statutory Trusts. What makes alternatives so powerful, especially for retirees, is that many of them don't move in lockstep with the stock market. That means when the S&P 500 is down, your entire portfolio isn't necessarily sinking with it. For example, income-produced real estate can continue to generate cash flow even during market downturns. Private credit may be their fixed income counterpart. Take General Motors, the companies we grew up with. This company is long gone. The current GM looks identical, but it's technically a new entity. Stockholders were wiped out. Bondholders got 10% of the outstanding shares of the new GM stock. They were owed $27 billion and fell far short, but senior secured loans were paid back in full during the Great Recession. These investments aren't new. They have been utilized by the ultra-wealthy institutions and endowments for decades. Historically, they were harder for individuals to access because of $5 and $10 million minimums, but that's no longer the case. Today, there are more accessible and more regulated and more transparent ways to include them in a portfolio, usually beginning with $100,000 per investment. Now, that doesn't mean alternatives are a silver bullet. They still come with risks, and not every alternative investment is right for every investor. But when carefully selected and properly integrated into a broader financial plan, they can offer something traditional portfolios increasingly struggle to provide: true diversification, potential for stable income, and a hedge against the volatility that tends to rattle retirees the most. In a moment, I'll break down how these alternatives can be used to complement, not replace, your core holding. But first, let's look at why this matters so much for people retiring right now. As you approach retirement, the entire purpose of your portfolio begins to shift. In your accumulation years, your 30s, 40s, and even early 50s, the primary goal is growth. You were building your nest egg, taking on some risk and focusing on long-term return. But once retirement is around the corner or already underway, everything changes. Now the name of the game is income stability, downside protection, and tax efficiency. This is exactly why alternative investments play a critical role in a retiree's portfolio. Let's break down the key reasons they work so well for this life stage. 1. Reliable income generation. Many alternative investments are designed with income in mind, something that becomes incredibly important during retirement. For example, real estate investment trusts and DSTs often distribute monthly or quarterly income from rental proceeds. Private credit investments can offer regular interest payment. Infrastructure and real assets may generate long-term cash flows with built-in inflation protection. These aren't speculative plays. They're meant to generate steady, predictable income, which is exactly what most retirees are working for. 2. Diversification beyond the stock market. When markets are volatile, and in 2025 that's almost a guarantee, having all your assets tied to equities or interest rate-sensitive bonds can leave you vulnerable. Alternative investments get help by mitigating that risk and is providing uncorrelated or less correlated returns. This means they don't always move in the same direction as traditional assets, giving your portfolio the cushion it needs during rough patches of the market. 3. Inflation protection. Retirees are uniquely exposed to inflation. Rising costs for healthcare, housing, and everyday expenses can erode purchasing power quickly. Some alternatives, particularly real estate commodities, have historically performed well during inflationary periods. That makes them a potential hedge to help protect your lifestyle over the long haul. 4. Access to institutional quality opportunities. Years ago, many of these strategies were only available to large institutions or ultra-high net worth investors. Today, that's changed. Through platforms like DSTs and other carefully structured vehicles, retirees now have access to institutional caliber investments without having to manage properties themselves or navigate complex private placements alone. This is especially important for those looking to exit actively managed real estate and replace it with passive, tax-efficient income without giving up the potential for growth. Number 5. Strategic tax benefit. Alternatives can also open the door to powerful tax strategies. For example, DSTs used in 1031 exchanges can defer capital gains taxes on appreciated real estate. Certain private investments may offer depreciation benefits or other tax advantage structure. Pairing these with traditional tax advantage accounts can improve your after-tax income in retirement. Alternative investments aren't a magic bullet, but for retirees seeking a portfolio that reflects their new priorities, they can be an incredibly effective tool. Not only can they help protect against the very real risks of retirement, market volatility, inflation, and income shortfall, they also give you more control over how your wealth supports your lifestyle moving forward. In the next section, we'll explore how to approach integrating alternatives into your plan, because while they're so powerful, they also require proper planning and guidance. Let's say you're retiring in 2025. You built up a $2 million portfolio, mostly in stocks and bonds, and you're concerned about volatility and want to protect your income. You might carve out 20 to 30% of your portfolio and allocate it to income-focused alternative investment, perhaps a DST or diversified private real estate fund. This allows you to generate consistent income, reduce exposure to the stock market, add tax-deferred growth or tax-efficient income, gain diversification through real property. Now when markets are turbulent, you're less exposed, and your monthly income doesn't come from selling off shares at a loss. This kind of balance can bring peace of mind, especially during the early years of retirement when sequence of return risk is the highest. Alternative investments are not for everyone, however. They may be illiquid. Minimums are often higher. You must do due diligence, understand the sponsor, the deal structure, the fees, and the risks. At Glasgow Investment Solutions, we believe in education first. We walk our clients through every option and only recommend solutions that align with their overall financial goals, risk tolerance, and retirement timeline. So who are alternatives right for? If you're retiring within the next 12 to 36 months, you may want to consider them. Concerned about market volatility impacting your withdrawals. You want predictable income without having to manage property yourself. You're staging out of investment real estate and want you to defer taxes. You're an accredited investor, seeking exposure beyond traditional stocks and bonds. If that sounds like you, then it may be time to have a deeper conversation about alternatives. Alternative investments are a replacement for a well-diversified portfolio. They're a complement. And in a world where markets are unpredictable and retirees are living longer, that added layer of stability can make all the difference. If you're within 12 to 24 months of retirement, or you're currently navigating a 1031 exchange and you want to explore what alternative and strategies may do for you, you too connect with us. You can book a time using the link in the description below, and we'll walk through your goals, your current portfolio, and how alternative strategies might fit into your bigger picture. Thanks for watching, and remember, retirement is too important to leave to chance. Let's build it intentionally.